Hello, hi. So today I was reading a paper, an academic paper on use of AI and advanced machine learning in finance, in quantitative research. Very interesting paper, and I thought of sharing some of the things from that paper. Mostly the reasons why AI and machine learning both are not that popular in finance compared to, say, in other sectors such as in healthcare or in e-commerce. Right, there are many reasons behind it. Right, AI is obviously very upcoming technology. We see now how Chat GPT is now disrupting a lot of things. Language models are disrupting many things, but people in finance are not that excited for a variety of reasons. Right, so AI and ML and less popular, right? And on a relative sense, the less popular in finance compared to in other fields. So what's the reason? Well, the less popularity is because of many reasons, but there are important ones. For example, it's very difficult to replace legacy models in finance compared to other areas, other domains, other businesses where you can change things faster. Where in finance, in banking in particular, it's very difficult to replace the legacy systems or legacy models. So the amount of money that will cost is something the banks are not very prepared about. The private funds are doing that. That is happening, but not the insurance company, big insurance company or big banks. And secondly, there is still no clear evidence that AI models do better compared to the traditional statistical models, especially in finance and investment. In fields like image recognition, voice translation, those areas, AI models do wonderfully well. However, it is not very clear whether the performance is significantly better in finance. Right, there are some evidences, but not many, and it's still quite debated within the quant finance community whether AI models do better than the traditional classical statistical models. It's also because these models are not computationally very efficient. If you run a deep learning model, it's going to take hours, right? In some cases, even days. And in some areas of finance, for example, in some areas of trading, high frequency trading, for example, you do not have a lot of time to execute your model, right? There, your speed matters a lot, and therefore ML models are not that used. And there is also another reason, which is the skill gap. It's not often discussed, but in finance you will find people from variety of academic backgrounds, but not many are from the tech background. People having experience in tech, like for 10 years, 15 years. You will not find people who have worked in with Apple or Microsoft or Google, and then coming to finance, in quant finance. So there are not many such people. So there is definitely a skill gap, and a lot of the people who actually work in finance, in the quantitative finance area, both in trading firms but also in banks and insurance companies, many of them come from physics, math, statistics, economics background, right? So people coming from these backgrounds may not have experience with the top tech, right? Deep tech, as we call it, right? Another reason is the regulatory pressure. In many areas, in regulatory modeling areas, in banks and insurance companies, you are not allowed to use models which cannot be explained or interpreted properly. Machine learning models are a bit complex. Sometimes people call them as black box models. You do not know what's going on inside. You only see the output. You can check the accuracy rate, but you do not know how it works, right? How if you change something in the input, how that is going to affect the output. It's actually possible. It's not that difficult. It's just that it's very difficult to convince the regulators also sometimes. But in deep learning models, actually, it's very difficult. But simpler machine learning models, such as boosting and bagging, I think it's quite possible to explain. So explainability is one other reason why machine learning, deep learning, both are not very popular in finance. Certainly not popular in big banks and insurance company. Becoming more popular nowadays in private funds. Many people are using. I was talking to a friend of mine. Is currently working in a crypto fund in London, and they're using reinforcement learning quite heavily there. But they're also using a lot of classical statistical model still. So the statistical models are still quite popular in finance, in quant finance. And then there are government regulations also. As you might know that Italy has banned use of ChatGPT. Many other governments and are also coming up with their AI policies, right? So banks and insurance companies or any financial organization, these companies do not want to take chances. These are heavily regulated companies. Too many regulations. Government influence is quite big in the industry, and it's an industry where the stakes are very high, right? In other fields, okay, your model doesn't work. Let's say in e-commerce, probably going to affect a couple of hundred customers, but in finance, a bank could go bust, it could go bankrupt, and that will have a systemic impact, and there might be a financial crisis because of that also. So the stakes are very high, so people therefore do not want to take chances there. And there are more reasons also. For example, I spoke about explainability. In finance, unlike in many other areas, it's not just about the predictions. If the model does a very good prediction, that's not enough. That's sure is important, but to be able to explain that if I change something in one of my input, how is that going to affect my output? This is very important. For example, in scorecard development, right? Your credit strategy depends on how you like to go ahead with, what sort of customers, and if you make some changes, how is that going to affect your overall credit risk for the portfolio, right? If that is not very clear, then it's not a good model. So therefore, you're not allowed to use complex models there. Simplicity is very much needed there. Although in my personal opinion, it's a bit overrated. People overrate the simplicity of models. Even the simple models are complex, and complex models, the so-called complex models are not necessarily that complex. Lack of infra is another issue in some companies, especially the European companies. I've seen they do not have good infrastructure. Also, they have money, but I'm not sure why they're not investing on infrastructure. So there is an issue of scalability. Having said that, the private funds are more willing to change, so they are more willing to embrace the changes happening around modeling techniques, from stochastic calculus based modeling to more data based modeling, data modeling, as in modeling using data, or more statistical modeling. That was the case a couple of years back, right? I think a couple of decades back, in fact. It was more physics-based models, mathematics models, stochastic calculus, some simulations, but not many people were using, let's say, time series modeling or regression modeling. They started using after 90s, and now machine learning is taking over. The more core statistical modeling. The US banks are more willing to change compared to the European counterparts. So that's another good observation, I would say. I worked with both, and I see that the European banks are a bit slow on that front, whereas the US banks are more willing to and more willing to change. Also, probably because of the regulatory um, the regulatory environment there, because Fed, I think, is better in that way compared to ECB. Fintechs are willing to change more than the big corporations. Many fintechs are using ML. They're also using alternate data, right? Not the traditional data, but also social media data, satellite image data, to assess credit worthiness of customers, which is impossible to do within a big bank. But many small tech firms are doing that to assess credit worthiness of individual customers, but also small and medium scale industries. Um, the conclusion of that paper is that the adoption rate is very slow. It is going to pick up quite possibly because of the increasing popularity. Some firms are using, so there will be a FOMO, and many other firms will start using. Probably this is going to happen in private firms, and there will be investment over there. But in big banks, I think the regulators are still not sure how much of that will happen. I was talking to one of my manager, actually was a manager to me, is a very big shot guy in finance, with long experience. He was telling me that I mean, the big banks will not survive if they do not adopt the new technology. In the fintechs will take over, and they will do things much better way compared to that of the big banks. You might have heard about Apple is now venturing into fintech, and given their presence in the consumer tech, I think they're probably going to gain a lot of customers. And given their technology advantage, AI technology and other advantages, they will be able to do financing in a much better way compared to the traditional banks, and that could hamper the profitability. And other tech firms will also venture into this space. So unless the big organizations change and embrace the change happening around the world, especially on the tech front, I think it's going to be a challenge. All right, please let me know your thoughts. If you're already working in any industry, any fintech or any banks or insurance companies, please let me know what's been your experience. Right? Have you ever tried to use something more advanced, and have you got the support, or have you got the pushback? Right? Please let me know in the comment. Thanks for watching. See you next time, guys.